So welcome back guys. In this session we'll be discussing on the financial institutions and the instruments in the financial market. So first we'll see the agenda, what we'll be studying in this particular chapter. So first we'll understand the structure and functions of the different financial institutions like the RBI. What are the functions of RBI? What is the structure of the RBI and what is the composition of the RBI, the Reserve Bank of India? And we'll see the functions of the commercial bank, the non-banking financial corporations or the insurance companies. So here we'll be discussing all the functions of the financial institutions, the RBI, the non-banking financial companies, the commercial banks, the insurance companies. So then we'll understand what is the concept of pension funds and some of the other concepts like the SEBI, what are the SEBI regulations, the alternate investment funds, and the concept of capital market, the money market and the money market instruments, capital market instruments. We'll see what is the shares, what are the instruments in money market, etc. So let's get started here. So financial institutions. So the financial system plays the key role in the economy by stimulating economic growth. So the main role of the financial system is to stimulate the economic growth, influencing economic performance of the actors, affecting economic welfare. So the financial institutions are very much concerned in the economic growth of the country. So how can this be achieved? This can be achieved by financial infrastructure. Example, banks, they give us loans. So if you are not having money, so if you want to start a business, one is that it should be bootstrap. Bootstrap means you should have the fund of your own. If you are not having fund of your own, you can approach the family members. So sometimes there will be a conflict between these family members, so they might not give the amount. The next viable option is to go for a bank loan. So if bank is okay with your business plan or okay with your action plan of your business or the project report which you submit to the bank, if they are okay with it, they'll fund your business at a minimal rate. So a financial system makes it possible more efficient transfer of funds. So it is an efficient way of transferring the funds, as one party of the transaction may possess superior information than the other party. It can lead to information asymmetric problem and inefficient allocation of financial resources. So if it is not a financial institution, there might be a problem. By overcoming asymmetric problem, financial system facilitates balance between those funds who invest and who are needing those funds. So it is a balance between both the things. Now, according to the structural approach, the financial system of an economy consists of three main components. So what in the MCQs they might ask, what are the components of financial system under the structural approach? We should tell the financial market, the financial intermediaries and the financial regulators. So regulators in the sense RBI in case of money market or the banking business, and SEBI in case of stock exchanges. Next, each of the components plays a specific role in the economy, though each one has different roles. So under the functional approach, financial market facilitate flow of funds in order to finance the investment by corporation. So it will enable the flow of funds. Financial institutions, what they do, they perform the function of financial intermediation and thus determine the flow. They are used for exchange of funds. So if I have an account in one bank and the other party is having in other bank, so there will be transfer of funds. So financial institution helps in that. So the regulators perform the role of monitoring and regulating the participants. So you might have heard of insider trading. So insider trading happens in stock market. So if a person is involved in insider trading, there is a penalty up to 25 CR or 3 times of the profit made from it, and it is imposed by SEBI, Securities and Exchange Board of India. So these are the this is the role of the regulators. Next we'll see the definition of financial institution. Financial institutions are the business organization. So it is not for profit, it is not a non-profit organization. It is mainly the purpose is for a business purpose. Are the business organizations that act as mobilizers of savings. So if you are having excess fund, where do you keep? In this time we keep it in bank. We can't keep it in cash because we don't know when there is another demonetization. So that's the reason we keep it in bank as a part of savings, or we may take a recurring deposit. If you are having a fixed monthly income and if you want to save those amount, you can go for a recurring deposit. And if you have a lump sum amount, suppose you sold a property and you have got a lump sum amount and you don't know where to keep, or you don't know how to make use of it for a certain time, and you want to use it after a long period, maybe after 1 or 2 years, you will you are planning to buy a building, so you can park it as an FD for 2 years. So if you are parking in FD, you will get an interest income. Instead of keeping in home or savings account, you can book it as FD. Okay. They also provide various financial services to the commodity. So they also provide other services also. Example, transfer of funds. They may act as our intermediary, or if you know, in any UPI apps, you can give a standing instruction that pay my electricity bill this month, pay my telephone bill, pay my Wi-Fi bill. So they will act on our behalf. Same in case of banks also. The financial business organization deal with financial assets. So they only deal with financial asset. They don't deal with land and building, etc. Only financial asset. Example, deposit. It may be RD or FD. Loans. If you are taking any loan, securities, the shares or the other securities like the debentures, bonds, etc. and so on. These assets can be seen on the asset side of the balance sheet of bank and any other financial institution. The non-financial institutions are those business which deal in real asset such as machinery, equipment, stock of goods, real asset, etc. These assets can be seen on the asset side of the manufacturing company. If it is a non-financial company, means a normal company. If you take any private limited, they will have the assets such as plant and machinery, land and building, furniture and fixtures, etc. on their asset side. For bank, it is loans which they give, deposits which they have kept in RBI, etc. The financial institutions are classified into banking and non-banking. So financial institution, there are two types. One is banking, one is non-banking. So in layman term, you understood that banking is something which will purely be in the business of money. It will take money, it will give money. There is no other thing happening in the bank. So banking institutions are those institutions in which participate in the economic payment system. That is, they provide transaction services. The deposit liability constitutes a major part of national money supply, and they can as a whole create deposits and credit, which is money. So nothing, they take deposit from us. It is a loan for the bank, which is a liability, because they have to repay us at any time. We may ask at any time, no? And the loans which they give to others is an asset for them. That's the thing. Okay, next we will see what is non-banking financial institutions. So there are other financial institutions also, but it is not engaged in banking business. It will be in other business. Example, insurance. Insurance is the classic example. So here if you can see, non-banking financial institutions are the institutions which act as a mere purveyor of credit, and they will not create credit. So they are not engaged in the business of lending. So that's the reason they can't create credit. And example are LIC, UTI, IDBA. According to Sayers, bankings are creators of credit because they will provide loans to everyone. You may be an individual, you may be a company, you may be a corporation, you may be a MLC. They will give loan for anything. If you want to buy a car, they will give a loan. If you want to buy a home, you can buy a loan, etc. So the financial institutions are classified into financial intermediaries and non-financial intermediaries. So there are basically two classifications here. One is the financial intermediaries and the non-financial intermediaries. So we will see what is the financial intermediaries. Financial intermediaries are those institutions which intermediate between savers and investors. They lend money as well as mobilize savings. So example, bank, they accept deposit from you. It may be in a form of fixed deposit, recurring deposit, or it may be in a type of savings account. So you may have a savings account. So the balance which is kept in savings account, it will be there. You can withdraw it, but that fund the bank will use for other thing. They may lend loan, they may invest in some other stocks, or it may purchase shares of a company, etc. Or they may purchase a mutual fund, depending upon the risk. So there will be a risk category. So this guideline will be given by RBI. RBI will give that bank should invest only in these funds. Example, treasury bills. So treasury bills are issued by the government of India. So it will be issued by RBI on behalf of government of India. So that it is 100% safe because the guarantee is given by the government of India. So banks are expected to invest in only those funds, not the risky funds. Example, the equity shares. So they are not allowed. So financial intermediaries are those institutions which are intermediate between the savers and investors. They lend money as well as mobile savings. Their liability towards the ultimate savers, because bank deposit is a liability for them and their assets are from the investors or borrowers. So anyone borrowing money from the bank is an asset for the bank. So the deposits which we keep in the bank are the liability for the bank. That is the reason all our savings account balance will be credited. If any amount is going to the savings bank account, it will be credited because it is a liability for the bank. So if you are depositing more and more amount, the liability of the bank will go up. If you are withdrawing less, it will be debited because the amount will be reduced in the bank account. Non-financial intermediaries are those institutions which do the loan business, but the resources are not directly obtained by the savers. So here they are in the only loan business, but they can't take amount from the customers or they can't accept amount from the savers or the ultimate customers. Many non-banking institutions also act as intermediaries, and when they do so, they are known as non-banking financial intermediaries. Example, LIC, GAC, IDBI, IFCA, NABARD. So NABARD is for the agriculture bank. Next, we'll see everything about the RBI, the functions, the composition, what are the role of RBI in the business or in India, etc. So RBI is the nation's central bank. So RBI is the sole authority in India for banking business. So they have the right to print money, they have the right to give banking license, they have the right to audit a bank, close a bank, merge a bank, everything. They have the ultimate power since 1935. So in 1935 RBI was formed. RBI began operations and stood at the center of Indian financial system with a fundamental commitment of maintaining national monetary and financial stability. So the main agenda of the RBI is that they have to maintain the national monetary and financial stability. From ensuring stability of the interest and exchange rates to providing liquidity and an adequate supply of currency and credit to the real sector. So they will be engaged in everything. So they will supply the currency, they will maintain the liquidity, so they will maintain the exchange rate. So if the exchange rate between dollar and rupees, they have the ultimate rate. Okay, and maintaining stability in the financial system through continued macroeconomic surveillance. So they will be having certain surveillance methods. Example, cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate. You would have heard in the newspapers that repo rate is increased, CRR is increased. So it will have a direct impact on the economy itself. RBI plays a crucial role in the economy. Decisions adopted by RBI touch the daily life of all Indians and help the chart of country's current and future economic and financial course. So we'll understand by an example. So recently you would have heard in the newspaper that RBI has increased the repo rate. So repo rate is increased by RBI. So now that will have so we'll understand the meaning of repo and reverse repo in the later classes, but I'll tell what is the impact. So once the repo rate is increased, all the loan interest rate will be automatically increased. If you are going for a loan and repo rate is increased, you will have a direct impact on the loan only. So loan interest rate will be increased. So repo rate is that interest which will be so the repo rate is the interest charged by RBI for the banks. So if bank wants amount, so if we want loan, we go to the bank for collection of the amount. If suppose the bank wants the amount, it will directly approach the RBI. So the rate charged by RBI for the banks on the amount obtained is known as repo rate. Once the repo rate is increased, automatically the interest rate on all the loans, example car loan, housing loan, automatically it will be increased. So next, The origin of RBI can be traced back to 1926. So they are telling that as per our information, we thought that it was in 1935 when the RBI Act was passed. Now they are telling that even before it has some background. So the origin of RBI can be traced to 1926, which means 9 years before the Act was passed, when the Royal Commission on the Indian Currency and Finance, also known as Hilton Young Commission, please mark this as important, it may be asked in MCQs. Hilton Young Commission recommended the creation of central bank to separate the control of currency and credit from the government and to augment the banking facilities toward the country. So the Reserve Bank of India Act of 1934 established the Reserve Bank as the banker to the central government. So first function is that it is a banker to the central government or the governments, and set in motion a series of action culminating the start of operation in 1935. Since then, the Reserve Bank's role and functions have undergone numerous changes. As per when a new function is required, government will pass an act and give power to the RBI. As the nature of Indian economy has changed, today's RBI bears some resemblance to the original institution, but the mission has expanded along with the deepened, broadened and increasingly globalized economy. Over the years, RBI's specific roles and functions have evolved. However, there has been certain constraints such as integrity and professionalism with which the RBI discharges its mandate. So, we will see the RBI at a glance. First is that it is maintained by Central Board of Directors. Then it is the Indian Monetary Authority to supervise the financial system, and no other government agency is allowed to do this except RBI. So manager of foreign exchange reserves, so it will be the manager of foreign exchange reserves. So you might have heard in the news that Indian foreign exchange reserves have increased due to the more FDI or the foreign direct investment in the country. So it is a banker to the government. So it is banker to the state government as well as the central government. So any functions of the government, which it may be giving subsidy, it may be giving pension, everything will be routed through RBI itself. Next, supervisor of payment system. So if you know, there is a payment system known as NEFT, RTGS, UPI, everything is managed by RBI. Bankers bank. So if we want loan, we'll go to the bank. If bank only wants loan, where can it go other than banks? So it can approach other banks. For that also it needs permission from the RBI. So first it will go to RBI, ask for money that we are in short of funds, please provide her. So RBI will charge an interest on that is known as repo rate. Maintaining financial stability. So you might have known that even if there is a war in outside country, you may take an example of Russia-Ukraine war, Israel-Palestine war. So the effects in Indian economy are minimal, not as expected, because RBI is intervening in that. It will be maintaining the financial stability. Then it has the other two functions, the developmental function, the research and data and knowledge sharing. So first we will understand the structure of the RBI, or the composition of RBI. So the RBI is wholly owned by Government of India, which means you can't purchase shares of RBI. It is 100% owned by the Government of India. The Central Board of Directors. So there are this Central Board of Directors to oversee the RBI's business or the day-to-day activities of the RBI. The central bank has the primary authority for oversight of the central board has the primary authority to oversight the RBI. So the board of directors are responsible for everything. It delegates specific functions through committees and subcommittees. Central board includes a governor. So you might have heard the governor Shaktikant Das. Shaktikant Das is the current governor of the RBI. So he will also be one of the board of directors, deputy governors and few directors of the local body. So RBI will have branches all over India, and at each level they will be having some board of directors. So the central board of directors include one governor and 4 deputy governors. at the central level, and these are the official directors. And next we have the non-official directors. First, there are 4 directors which are nominated by the central government to represent each at a local board, and 10 directors nominated by central government in expertise with various segments. So RBI requires certain subject matter expertise from stock market, banking business, or the loan business, and we'll have certain sectors in the economy. So there may be, RBI may have a future goal that they have to make something for the automobile industry, so they'll call a subject matter expert from the automobile industry, etc. So, and the 2 representatives from the central government. It may be a secretary to the revenue secretary or some other persons as required by the government of India. Holding of meeting. So every company will have a meeting. So same in case of RBI. RBI will have 6 meetings each year and at least 1 meeting in each quarter. So in total they should have 6 meetings in a year, but in quarter at least they should have one meeting. Committee of the Central Board. What is the role? Oversees the current business of the central bank and typically meets every week on Wednesdays. The agenda focuses on current operations, including approval of weekly statement of accounts. So they will be approving the weekly statement of accounts. Next we have the Board of Financial Supervision. So this, what is the role of this? So regulates and supervises commercial banks, NBFCs, development finance corporations, institutions, urban cooperative banks and primary dealers. So this is the role of the Board of Financial Supervision. Next, Board of Payment and Settlement System. It will be engaged in the payment and settlement system. There are some subcommittees of the Central Board, including the audit and inspection. So this is very much important because you might have heard the S Bank case. Every bank will try to manipulate the accounts. So that is the reason RBI will have regular inspection, regular audit of every bank in order to check whether the affairs of the bank is true and fair. So that is the agenda of the inspection and audit department. Staff and building and focus of each committee is on the specific areas of operation. So they'll have, each department will have operation and it will be performing on the basis of the agenda or the task given. Local boards in Chennai, Kolkata, Mumbai, New Delhi, representing the country's 4 regions. Local board members appointed by the central government for 4 years. So this you can write it here. So the term is 4 years. Represent region and economic interest and interest of the cooperative and indigenous banks. So they will be giving their opinion based on the market research. So next, management and structure. So the governor is the RBI chief executive. So he is the sole responsible for all the decisions of the RBI. The governor supervises and directs the affairs and business of the Reserve Bank. The management team also includes deputy governors and executive directors. So the RBI has the following departments and sub-departments. So if you can see, these are the departments. So it has the Department of Market, Research, Regulation, Services, Support, and the sub-departments. Example, the Monetary Policy Department, Financial Markets. So it is based on the requirement in the market or the economy. So if there is a requirement of a new wing, they will establish that wing and supervise that as per the requirement. So the inspection department, legal department, secretary department, premises, information technology. So these are some of the departments and sub-department. So next we'll see the activities of RBI. What is the main activities of RBI? First and foremost, the monetary authority. So it is the sole agency which is responsible for the monetary policy in India. Next, issuer of currency. So if you see any notes in any Indian currency, in the top it will be written as Reserve Bank of India. So every notes are given by the RBI, and the coins, some coins it will be issued by Government of India. If you can see, some of the coins 2 rupees, sometimes 5 rupees are issued by the Government of India, except that every currency notes are issued by the RBI. Banker and debt manager to the government. So it is bankers bank as well as the banker to the governments. Next we have it is the regulator of banking system because it has the sole authority to do it, and it will be maintaining the foreign exchange management. So it is the regulator and supervisor of payment and settlement system, and maintaining the financial stability, and then it has the developmental role. So these are some of the activities which are undertaken, or the functions which are undertaken by the RBI. Next, monetary policy. So first we'll be discussing each one in detail in class itself, because if you're since it is an online class, if you are traveling in a bus, you can just put on your earphones and be hearing this. So it will be a kind of revision. If you can put it in 1.5x or 1.75x, it will be kind of revision. So that's the reason we'll be covering each and every line in the class itself. We don't know where the MCQs will come from. We don't know where the fill in the blanks or true or false will come from. So that's the reason we'll be going line by line. Monetary authority. The RBI controls the credit and formulates the monetary policy. What is this monetary policy? Monetary policy refers to the use of instruments under the control of the central bank to regulate the availability, cost and use of money and credit. So RBI has certain instruments, CRR, SLR, so cash reserve ratio, statutory liquidity ratio are some of the instruments which it will be using to control the flow of credit in the economy, or the flow of money in the economy. So what is the objective of this monetary policy? First is that it should maintain the price stability. So there will be fluctuation as per the, if you have heard the word inflation, due to inflation there will be fluctuation in the prices of the commodities. So in order to regulate that, monetary policy is required. Ensuring adequate flow of credit and produce to the productive sectors of the economy to support economic growth and the financial stability. So if you can see, there will be sometimes the bank will not be lending loans to everyone. So they will be holding the credit, because if there is an excess flow of money in the market, the value of the money will come down. If you take an example, now if you have 100 rupees, you will spend only 100. If you are having 1000 rupees, you will spend 1000 rupees also. So that is the reason the value of money will come down. That is the reason it will be controlling the credit to some of the instruments. So next, the RBI's monetary policy department formulates the monetary policy. So RBI, under RBI we have a department known as monetary policy department that will be giving the monetary policy. So it will be formulating the monetary policy. So the financial markets department handles the day-to-day liquidity management operation. There are several direct and indirect instruments that are used in the formulation of implementing monetary policy. So what are the direct instruments? CRR, SLR, refinance facility. So these are some of the direct instruments. Next we have the indirect instruments. What is that? Bank rate, repo rate, the market stabilization scheme, open market operation. They will be purchased from the open market itself, marginal adjustment facility and liquidity adjustment facility. So these are some of the instruments. So we'll see one by one. First is the cash reserve ratio. What is this cash reserve ratio? We'll see that the average daily balance at the bank is required to maintain with the Reserve Bank a share of at such percentage of its net demand and time deposits. So RBI is telling that the average balance of your demand and time deposits. Demand and time deposits refers to savings account. In case of demand means you can ask whenever you want. If you are having amount in savings balance, you can take it at any time. It is your wish. That is the demand deposit. Time deposit refers to recurring deposit and the fixed deposits. So the average balance of that on a day basis, there is a certain percentage of amount which should be kept with RBI. Suppose we'll take an example of 1000 rupees is the average balance of time and demand deposit. So that is the average balance. Out of that, a small portion, take it as 5%. 5% you should keep it with RBI, because we don't know, going forward the bank may incur loss and will not be able to repay its deposit to the deposit holders or the savings account holders. Then RBI will come in and it will be paying the balances to the account holders. So that is the reason RBI will tell that please keep a certain amount, a certain percentage of the time and demand deposit with the RBI. That is known as cash reserve ratio, that the RBI may notify from time to time the Gazette of India. The share of net demand and time liabilities, that bank must maintain a cash balance with the reserve bank. It should be keeping that balance with the reserve bank. The reserve bank requires banks to maintain a certain amount of cash in the reserve as a percentage of the deposit to ensure that the bank gave sufficient cash to cover the customer withdrawals. The adjustment of this ratio is done as an instrument to the monetary policy depending on the prevailing conditions. Our centralized and computerized system allows the efficient and accurate monitoring of the balances maintained by the banks in the RBI. Next we will see the statutory liquidity ratio. The share of the net demand and time liabilities that the bank must maintain in safe and liquid assets such as government securities, cash and gold. So out of 1000, 5% you have kept with RBI, and over and above that RBI is also telling that you keep certain percentage of amount in the form of government security, cash and gold, because it is 100% liquid. If you go in the market and sell the gold, you will get the cash. If you go in the market and sell the government securities, you will get the cash. Cash also it is in the cash form itself, so there is no requirement of selling it. So RBI is telling that you should keep certain percentage of amount in SLR also. So now bank is account holders are safe because certain amount is with the RBI, certain amount is in the form of gold, cash or the government securities, which is 0% risk. Next, refinance activities. Sector specific refinance activities. Example, against lending of export sectors provided to banks, exchange or other commercial papers. It also signals the medium term stance of monetary policy. So they will be refinancing some of the facilities. Next we will see the indirect instruments. So first one is the liquidity adjustment facility. Consists of daily infusion or absorption of liquidity on a repurchase basis through repo liquidity injection or reverse repo liquidity absorption. So we'll see they are telling that it will use the repo rate and reverse repo rate to control the monetary policy. First is the repo rate. The repo rate is the fixed interest rate at which the RBI provides overnight liquidity to the bank. So if bank wants some amount, it will approach the RBI. RBI will give the funds and charge an interest rate that is known as repo rate. Okay, against the collateral of the government or other approved securities under the liquidity adjustment facility. Reverse repo rate. So reverse repo rate is the rate at which RBI observes liquidity on an overnight basis from the banks against the collateral to the eligible government securities under the LAF. This rate under the liquidity adjustment facility determine the corridor for short-term money market interest rate. This is that RBI will take loan from the bank. In this sense, RBI will observe the over liquidity. If some bank has overflow of amount, overflow of money, it will observe from that bank and give an interest rate, interest to the bank. So this interest is an income for the bank. So this is done because to observe the overflow of money in the market. So this is the rate given by RBI to the bank. Repo rate is the rate charged by RBI, whereas the reverse repo is the rate interest rate given to the bank or the economy. Corridor. So the MSF rate and the reverse repo rate determine the corridor for daily movement of the weighted average call money rate. Next, open market operation. Outright sales, purchases of government securities in addition to LAF as a tool to determine the level of liquidity over the medium term. Open market operations means RBI will go into the market and purchase the government securities. So that is the thing. Margin and standing facilities in the MSF was instituted under which scheduled commercial bank can borrow overnight at their discretion up to 1% of their respective net demand and time liabilities at 100 basis points over the repo rate to provide a safety value against unanticipated liquidity shocks. So it can borrow at a overrate but at 100 basis points above. 100 basis points means 1% above the reverse repo rate. sorry, above the repo rate. So repo rate is 4%, which means it can borrow at a lower rate for shorter period at 5%. Example. So 100 basis points refers to 1%. Bank rate, it is the rate at which RBI is ready to buy or rediscount the bills of exchange or other commercial papers. It also signals the medium term stance of monetary policy. The bank rate is published under the section 49 of the RBI Act 1934. This rate has been aligned to MSF rate, therefore changes automatically as and when the MSF rate changes alongside the repo rate. So it is the rate at which the bank will purchase the bills of exchange or the commercial bank from the banks. Market stabilization scheme. This instrument for monetary management was introduced in 2004. Liquidity of a more enduring nature arising from a large capital flows is observed through sale of short-dated government securities and treasury bills. This mobilized cash is held in a separate government account with the Reserve Bank. So this is known as market stabilization scheme. So next function, first function is monetary policy. Next, it is an issuer of currency. Every currency notes in India, it should be issued by the RBI. RBI is the nation's sole note issuing authority. No other authority of the government or the agency is allowed to give currency notes except RBI. Along with the government of India, RBI is responsible for design and production and overall management of nation's currency, with the goal to ensuring an adequate supply of clean and genuine notes. The Department of Currency Management at the central office. So which department? Department of Currency Management at central office Mumbai. So RBI's head office is in Mumbai. In cooperation with the issue departments of the RBI, regional officers across India oversees currency management. This function includes supplying and distributing the adequate quantity of currency throughout the country and ensuring the quality of banknotes in curriculum by continuous supply of clean notes and timely withdrawals of soiled notes. So it will be issuing new notes and taking back the soiled notes, which means the damaged notes. Indirect instrument. 4 printing presses have actively print notes. So there are only 4 branches of RBI which is responsible for printing the notes. First one is Devas in Madhya Pradesh, Nasik in Maharashtra, and Mysore in Karnataka, and Salboni in West Bengal. So only these 4 places RBI will mint the currency or the print the currency. The presses in Madhya Pradesh and Maharashtra are owned by Security Printing and Minting Corporation of India, a wholly owned company of the Government of India. The presses in Karnataka and West Bengal are set up by Bharatiya Reserve Bank Note Mudran Private Limited, a wholly owned subsidiary of RBI. So it is the wholly owned subsidiary of RBI, and the above is the wholly owned company by Government of India. Coins are minted by the Government of India. As I told, coins are given by Government of India. RBI is the agent of the government for distribution and handling the coins. 4 mints are Mumbai, Noida, Kolkata and Hyderabad. Coins are minted here. So banker and debt manager to the government. So every transaction of the government is routed through RBI. Managing the government's banking transaction is a key role of RBI. Like individuals, businesses and banks, governments need a banker to carry out this financial transaction. What are the financial transactions? They'll give subsidy, they'll give pension, they'll transfer amount for contractors who do the roads, bridges, etc., who do the structures, infrastructure activities, etc., in an efficient and effective manner, including the raising of resources from the public, because people have to pay tax to the government. No, that also is routed through RBI itself. As a banker to the central government, the Reserve Bank maintains its accounts, receives money into and makes payment out of these accounts and facilitates the transfer of government funds. RBI also acts as a banker to those state governments that has entered into an agreement. So if any state government has entered into an agreement with RBI, it will provide facilities to that state government also. Normally in India, every state government has accounts with RBI and every transaction will be routed through RBI itself. The role as banker and debt manager to the government includes several distinct functions. So what are the functions? First one, undertaking banking transactions for the central and state governments to facilitate receipt and payment and maintaining the accounts. As I told, government will collect tax from the citizen and give facilities in the form of pension, subsidy, etc. Managing the government's domestic debt with the objective of raising required amount of public debt in a cost effective and timely manner. So government cannot perform every developmental activities only with the help of tax money. They have to borrow from the outside financial institutions. Example, International Monetary Fund, other banks of in other countries, or other governments like the Japanese government will be investing in Indian infrastructure activities, etc. Developing the market for government securities to enable the government to raise debt at a reasonable cost, provide benchmark for providing resources by other entities and facilitate transmission of monetary policy actions. At the end of each day, RBI's electronic system automatically consolidates all the government transactions to determine the next final position. If the balance of the government account shows a negative position, RBI extends a short-term interest-bearing advance called the ways and means advance. So this is the important term. Please be aware. Ways and means advance, because if there is a negative balance in the government account, for which is set at the beginning of financial year in April. Next we have Bankers Bank. So Bankers Bank. Banks are required to maintain a portion of their demand and time liabilities as cash reserves with the Reserve Bank. This is known as CRR, cash reserve ratio. For this purpose, they need to maintain current account with the RBI. The current account of the banks is opened by the banking departments of the RBI regional offices. The current accounts of the individual banks are being opened in eKuber, the CBS of core banking system of RBI. CBS refers to core banking system, by the banking departments of the regional offices. These current accounts are also maintained for participation in the centralized and decentralized payment system and are used for settling interbank obligations such as clearing transactions or clearing money market transaction between two banks. So RBI will act as an intermediate between the transaction between two banks, settlement of transaction between the two banks, buying and selling securities and foreign currencies. Thus, the Reserve Bank acts as a common banker known as banker to banks function. So, the operational instructions for which are issued by the concerned central office departments of the RBI. As banker to banks, RBI or the Reserve Bank provides short-term loans and advances to select bank. It will not provide to every bank. It will be providing for the select bank when necessary to facilitate lending to a specific sector or for specific purpose. So it will be giving short-term loans for the specific sector or for a specific purpose. As a banker to the bank, RBI focuses on enabling smooth, swift and seamless clearing and settlement of interbank obligation. So it will be engaged in that. Providing an efficient means of fund transfer. So it will be providing a gateway or a platform for easy fund transfers, enabling banks to maintain their accounts with us for purpose of statutory reserve requirement and maintaining transaction balances. Act as a lender of last resort. So this is an important function, because if any bank has lost everything in its account, it can approach the RBI to help to come out from that. The RBI will act as a last resort. It may help in giving the CRR to close the balance or to repay. It may provide extra term. It may merge with another bank. It may provide a short term facility to come out of that loss, etc. The RBI provides products and services for the nation's banks similar to what bank offer to their own customers. So what facilities we get from our bank, same facilities RBI will give to the banks. And in India, you cannot start a banking company or a business without the license from the RBI. And taking license from RBI, I'll tell you, is too tough. It's too tough. Next, regulator of banking system. As I told you, RBI is the regulator of all the banking system in India. The RBI has critical role to play in ensuring safety and soundness of the banking system and in maintaining financial stability and public confidence in the system. As a regulator and supervisor of the banking system, the Reserve Bank protects the interest of depositors, ensures a framework for orderly development and conducting banking operations conducive to the customer interest, and maintains overall financial stability through preventive and corrective measures. The RBI or the Reserve Bank regulates and supervises the nation's financial system. It will be regulating the whole nation's financial system. So different departments of the banking operation and development supervised by the Department of Banking Supervision. So what will RBI oversee? It will see the commercial banks and all India development financial institutions, which means Indian Finance, IDBI, Industrial Development Corporation, Developmental Bank of India, IFCA, Indian Financial Corporation of India, state financial corporations, etc. Urban cooperative societies are now under the purview of RBI. Earlier there used to be more scams at the cooperative banks. Now the scam bill has come down because earlier it was under state government. Now it is under the direct purview of RBI. RBI will ask the accounts of every cooperative societies. It can even inspect the cooperative bank. It can audit the cooperative bank. That is the reason the rules are now stringent. Regional rural banks, district central cooperative bank and national state cooperative banks are regulated by the Rural Planning and Credit Department and are supervised by the NABARD. NABARD is the National Agriculture Bank for Agriculture. And the NBFCs. NBFCs are regulated by the RBI. NBFCs are only allowed to lend loans, but it does not have the authority to accept the deposits. Next, RBI makes use of several supervisory tools. One is the inspection. It can inspect any bank at any time. No one can question that. Next, offsite surveillance and making sure the required reporting by the regulated entities. Thematic inspection, scrutiny and periodic meetings. So it can do anything. No one can question this. The Board of Financial Supervision oversee the Reserve Bank's regulatory and supervisory responsibilities. Consumer confidence and trust are fundamental to the proper functioning of banking system. Customers should have confidence and trust on the bank. Now we believe in our banking system. That's the reason we keep every balances or our hard earned earning in the bank. Otherwise we would have kept in the form of cash. No. So that's the reason bank should maintain confidence as well as the trust. The balance in my bank account, it should not be shown to other person. It should be only seen to me. That is the confidence or the trust I have on the bank, that the balance of in my bank account will not be shown to other customers or other family members. So that is the confidentiality which should be maintained by the banks. RBI supervision and regulation helped ensure that banks are stable and that the system functions smoothly. As a nation's financial regulator, RBI has the following activity. First, as I told, licensing. So every banking license is issued by RBI, prescribing the capital requirements. What should be the minimum capital to start a bank or the NBFC? Monitoring governance. What is the governance? Setting prudential regulations to ensure solvency and liquidity of the bank. So they'll have the prudential regulations. What if the bank goes down or occurs loss on a continued basis? Prescribing lending and other priority sectors. So RBI will tell which sectors of the economy or which parties should be given. Next, regulating interest securities in specific areas. So it will tell the interest area. So for if you go for agriculture, the interest rate will be slightly less because the loan, the farmer who avails the loan cannot pay at what interest rate a business is paying, and sometimes there will be waiver of interest by the governments for the farmers, or sometimes waiver of the principal itself, etc. Setting the appropriate regulatory norms related to the income recognition, asset classification, provisioning, and investment valuation, exposure limits, and like initiating new regulation. So these are some of the functions or the activities of the RBI. Next we have the foreign exchange management. So what is this foreign exchange management? Is that any country should have minimum foreign exchange reserves, because India has rupee. Now if you want to buy a petrol, the amount will be transacted in US dollars. So if the country is having reserves of US dollar, it is not required to approach other bank. So American bank, example take Standard Chartered or any other bank, they will have USD in their balances. Now if I want USD, I will approach the bank that I want this much USD. Bank will approach RBI. RBI will approach other bank or the foreign banks for USD. If suppose RBI is only having the USD, the rate is less, the cost is less, because the cost for buying USD is more. Now if it is having already in the reserve, then no issues. So that is the reason country will maintain more and more of forex reserves. So when will it happen? If there is more and more inflow into the country, then we will have more and more of foreign reserves. With the transition to a market-based system for determining the external value of an rupee, the foreign exchange market in India gained importance in the early reform period. So this reform period which they are referring to is 1991, when India opened the gates to all the foreign entities to establish their companies in India. So it was a major reform for Indian economic development which happened in 1991. In the recent years, with increasing integration of Indian economy with the global economy arising from a greater trade and capital flows, the foreign exchange market has evolved as a key segment of the Indian financial market. So foreign exchange market is growing very big in India because there is more and more inflow in the form of FDI or the investments into India. The Reserve Bank plays a role in the regulation and development of foreign exchange market and assumes three broad roles relating to foreign exchange. What are the roles? Regulating the transactions related to external sector and facilitating the development of foreign exchange market. So it will facilitate the development of foreign exchange market and the regulation. So keyword is regulation and development. Next, ensuring smooth conduct and orderly conditions in the domestic foreign exchange market, ensuring the smooth functioning, managing the foreign currency assets and gold reserves. So it will have to maintain that. The Reserve Bank is responsible for administration in the foreign exchange market, FEMA Act. So FEMA is an act passed by the government for regulation of foreign currency and regulates the market by issuing licenses to bank and other select institution to act as an authorized dealer in foreign exchange. So if you want to transact in foreign currency, you have to have a license from the RBI to act as an authorized dealer. Now for this you can take an example. Now if you want to travel abroad, you will contact a travel agency. Sometimes they will provide a card, forex card. So the travel agency, if it wants to give a card to the traveler, it should have a AD license, which is authorized dealer license, which is given by RBI. Then only it can give forex cards to you. Okay, so this is the example of authorized dealers. So you can take any example. There are many in India. If you take Thomas Cook, it is one example, and there are many things like who will give you foreign exchange. If you give rupees, they will give you other currency. If you give rupee, they will give you dollar. If you give rupee, they will give euro. But everything it should be purchased from RBI, and you should have the authorized AD license, which is the authorized dealer license to transact in that. Sorry. Foreign Exchange Department is responsible for the regulation and development of the market. On a given day, Foreign exchange rate reflects the demand and supply of foreign exchange arising from trade and capital transaction. Amount can be taken for normal day-to-day business also, as a capital investment also. RBI's Financial market department participates in the foreign exchange market by undertaking sales purchases of foreign currency to ease volatility in the periods of excess demand or supply. So it will be in the participating in the open market to purchase the foreign currencies. The Department of External Investment and Operations, DEIO, invest in foreign exchange reserves built up by purchase of foreign currency from the market. In investing foreign assets, Reserve Bank is guided by three principles. It should be safe, it should be liquid, and we should have a proper return. This is the three requirements when it is going for foreign investment. Next, we have the supervisor of payment and settlement systems. Payment and settlement system play an important role in improving overall economic efficiency. We'll understand by a story, okay? 20 years back, whatever we purchase, we'll pay it through cash. Now, in 2024, we don't have that situation because everything will be routed through UPI. Scan a QR code, pay the amount. In 20 years back, ask your grandparents, they'll not even have the idea of UPI 20 years back. Now they are using. 20 years back, it was purely through cash. Everything was paid through cash. Electricity bill, go to the ESCOMs, electricity companies, pay it. Now you can pay it online itself. You can pay it through UPI apps, you can pay it through websites, you can give a standing instruction to the banks, etc. Everything can be done sitting in home. 20 years back, not even 20 years back, 10 years back, it was not the same situation. We have to go to the ESCOMs, we have to stand in a queue, wait for our turn, then pay it through cash. Now, you can sit here only, pay it within a minute. So, that is the change which is undergone in the payment and settlement system. So, for that, we should thank the RBI. It is helping us to save our time and invest in some other means. The Payment and Settlement System Act of 2007 gives the RBI oversight authority, including regulation and supervision for the payment and settlement system in the country. In this role, RBI focuses on development and functioning of safe, secure and efficient payment and settlement mechanism. So now there is a gateway, example Razorpay. I'm telling some of the gateways. In India we have BillDesk. These are some of the payment gateways which will help in making the payments. The Reserve Bank has two-tiered structure. The first tier provides basic framework for our payment system. The second tier focuses on supervision of this framework. As part of basic framework, the Reserve Bank's network of secure systems handles various types of payment and settlement activities. Most operate on a security platform of the Indian financial network using digital signatures or for security of transactions. So what are some of the payment system? Retail payment system are example check clearing. You can sign a check and give it. Electronic fund transfer, EFTs. So what is NEFT which will take on at certain intervals, maybe 1 hour depending upon the banks. Settlement of card payments and bulk payments such as electronic ECS. So if you sign an ECS form, it will be automatically debited. Example, if you are taking a car on EMI, if you sign the mandate form or the ECS mandate, on this particular date, amount will be debited. If you take on second of every month, on second, it will be debited. If it is a negative balance, then you will get a penalty. It is a standing instruction operated through local clearing houses throughout the country. Large value system facilitating settlement of interbank transfer. So the volume of money transferring between each bank is very high. We can't even count the digits at some times. Next we have the other facilities like RTGS. So the limit for RTGS is more than 5 lakh, I guess. If it is more than 5 lakh RTGS, it will be done within 5 minutes. Security settlement system for government securities market. Foreign exchange clearing for transactions involving foreign currency. Department of Payment and Settlement System It is a regulatory arm. Next, information technology, it will give information. Next role is maintaining financial stability. Pursuant to financial stability has emerged as a key policy objective of the central banks in wake of recent global financial crisis. Central banks have a critical role to play in achieving this objective. Though financial stability is not an explicit objective of the RBI in terms of as per the act, but it has been explicit objective of the RBI since the early 2000s. So even if it is not in the act, now it is very much required to maintain the financial stability of the country. In 2009, RBI set up a dedicated financial stability unit mainly to put in place a system of continuous monitoring and macro financial system. The department's activities include conducting a macro prudential surveillance of the financial systems on an ongoing basis, developing models for assessing financial stability going forward, and preparation of half-yearly financial stability report. So they have to prepare a report on half-yearly basis, which is the 6 months. Development of database for key variables such as which would impact the financial stability, and so on and so forth. Following the establishment of financial stability unit, the RBI started publishing periodic financial stability reports, with the first financial stability report being published in 2010. So this you can refer actually. This you can refer and see what are the contents of the report. FSR, financial stability reports, are now being published on a half-yearly basis in June and December. See, June and December they will be publishing. Internally, quarterly system risk monitors and monthly market monitors are prepared to place before the bank's top management for more frequent assessment of the risk to systematic stability of the economy. Next is the developmental role. So this is very much easy. So RBI will undertake actions to develop the economy or economic growth. This role includes ensuring credit availability to the productive sectors of the economy, establishing institutions designated to build the financial infrastructure. So it will build the financial infrastructure, expanding access to affordable financial services, and promoting financial education and literacy. Over the years, Reserve Bank has added new institutions as the economy has evolved. Some of the institutions established include deposit insurance and credit guarantee scheme. So this DACGC is one such step. If the bank, so it will provide guarantee to the bank depositors extended over a certain category. So if any banks, or if there is a fraud or scam in any bank and the bank is closed, now the depositors amount is gone. Now RBI intervenes and gives the insurance, deposit insurance, and that is there is certain amount fixed, and that amount will be given to the account holders. Next, Unit Trust of India is the first mutual fund. So mutual fund, what is this mutual fund? Mutual fund will take amount from the investors and it will diversify the investment. So it will take, so there are certain mutual funds, okay, debt fund, equity, certain specific sector specific funds. So they'll take amount from the investors and it will accumulate say 1000 crores, and it will be putting in every company. If it is a infrastructure fund, it will be putting amount in the infrastructure companies. If it is a petroleum mutual fund, it will put in petroleum companies. If it is a health sector, it will put in health sector. If it is on a priority sector, it will put in the priority sector. If it is a debt fund, it will only invest in debt instruments, not the equity or the stocks. Next, they have established NABARD, actually, National Bank for Agriculture and Rural Development. It will help the promoting the rural and agriculture credit. So because no bank will give to farmers, so that is the reason NABARD was established. Discount and Finance House of India, a money market intermediary and primary dealer in government securities. National Housing Bank, which provides loans for housing business. And Securities and Trading Corporation of India, a primary dealer. So RBI continues its developmental role, which specifically focus on financial inclusion. Key tools in this ongoing effort include direct credit for lending to priority sector and weaker sections. So the goal here is to facilitate and enhance credit flow to the employment intensive sectors such as agriculture, MSME or the MSc, as well as the affordable housing and education loans. So they will be providing direct credit to them. Lead bank scheme. What is this scheme? A commercial bank is designated as lead bank in each district in the country, and this bank is responsible for ensuring banking development in the district through coordinated efforts between the bank and government officials. Reserve Bank has assigned a lead district manager for each district who act as a catalytic force for promoting the financial inclusion. What is this? That there are many villages in India who do not have banking facilities. So in order to develop the banking business, RBI will establish at a district level one person who will be coordinating with the banks to provide, who will help in opening the new bank accounts in the particular district where there is less accounts. Sector specific refinance. So RBI makes available refinance to the banks against their credit to the export sector, because if there is more and more export, we will get more foreign exchange reserves. In exceptional circumstances, it can provide refinance against lending to other sectors also. Strengthening and supporting small local banks. So RBI also helps in developing the rural banks, which is very small in size. Financial inclusion is the sense promoting the financial literacy, means asking everyone to open a bank account, transact everything to banking only, use minimal cash, route every transaction to in the bank account itself, so that government will have a count on it, or there is less tax evasion. RBI's work to promote financial literacy focuses on educating people about responsible financial management. Efforts here include information and knowledge sharing. User-friendly website includes easy to understand tips and guidance in multiple languages. So RBI is taking measures to make understand how the bank works, what are the facilities in the bank, what you should know before you should go to bank. Everything they will be presenting in their website in multiple languages. Every person who knows their native language should understand what is going on in the bank and what you should know before you go to the bank. Brochures, advertisement and other marketing materials educate the public. Credit counseling. The Reserve Bank encourages commercial banks to set up financial literacy and credit counseling centers to help bank develop better financial planning skills. So these are some of the developmental activities which is undertaken by RBI. So by this we have completed everything about RBI. So we have seen the introduction to RBI, the composition of RBI. See, introduction, the structure of RBI, the departments of RBI and the functions of RBI. Okay, now we'll go to the commercial banks. So our next financial institution is that the commercial bank. We have completed the Reserve Bank of India or the RBI. Commercial banks are part of a organized money market in India. So they come under the surveillance of RBI and it is a part of organized money. So there are many unorganized way also, because you would have known about pawn lenders. So they'll keep the gold, they'll keep the property papers, they'll give the amount. Those guys are not regulated by RBI. Commercial banks are regulated by RBI, and that is the reason it is an organized part of organized money. There they'll charge heavy interest. They'll charge 5%, 6% per month. I am telling, per month. That is the reason. Commercial banks are a joint stock company dealing in money. It should be a joint stock. It should be a company. A sole proprietor cannot start a business. A partnership firm cannot start a banking business. dealing in money and credit that accept demand deposit from public. Demand deposit is savings account, recurrent deposit, fixed deposit, which are withdrawable by checks and use these deposits for lending to others. They'll accept deposit from the account holders and give it to the required people in the form of loan. Deposits are accepted by from large group of people in the form of money, and deposits are withdrawable on demand. Commercial bank mobilize savings in urban and rural areas and make them available to large and small industrial units and trading units, mainly for working capital requirements. Commercial banks provide various types of financial services to customers in return of fees. If bank will give loan, they'll ask the interest. If they're doing any other services, they'll ask the fees. So banks are majorly divided into two types: scheduled commercial bank and non-scheduled commercial bank. What is this scheduled commercial bank? Scheduled bank is so called because it has been included in the Schedule 2 of the RBI Act. So any bank included in the Schedule 2 of the RBI Act is known as scheduled bank. To be eligible for this inclusion, the bank must satisfy three conditions. So they are telling it should satisfy all the three conditions. First one, paid up capital and reserves, it should be 5 lakh. They are telling the first condition is that paid up capital plus reserves should be more than 5 lakh. It must satisfy the RBI that the affairs are not conducted in a manner damaging the interest of the depositors. It should be true and fair. The affairs of the banking company should be true and fair. It must be a corporation and not a partnership or a single owner firm. As I told you, it should be a company and not a sole proprietor or a partnership firm. Scheduled bank enjoy the following advantages. What are the advantages? Free and concessional remittance facilities through the offices of RBI and its agent. So it will be free sometimes, or it will be at a concessional rate. Borrowing facilities from the RBI by depositing necessary documents. So it can take loan from the RBI. In return, scheduled bank are under obligation. So advantages are these, and it is having certain obligations. What are those obligations? Maintain a daily balance of cash reserve, which is the CRR. So it should maintain CRR and SLR on a daily basis, and submit periodical returns to RBI under various provisions of the Act and Banking Regulation Act. It should be providing the periodical returns. So it may be financial statements, it may be other reports which is related to the amount or the money, etc. All commercial banks such as Indian, foreign, RRBs or state cooperative banks are scheduled banks. It comprises of public sector banks, example SBI, all the nationalized banks, RRBs, private sector banks, small finance banks, scheduled payment banks, and foreign banks. I'm sorry. So these are the number of banks with branches. So there are, as per the 2019 data, these are the number of branches of banks. So private sector banks have 32,000 branch, public sector have 87,000 branches. So RRBs are 22,000 and foreign banks have 300 branches. This is as per 2019 data. Now it would have definitely increased. Presently, 12 small finance banks and 4 scheduled payment banks are operating in India. So you can take it as an exercise that you can find out all which are these banks. So to have an idea. Next we will see non-scheduled banks. Non-scheduled banks are also subjected to statutory reserve ratio, which is the CRR. But they are not required to keep them with RBI. They may keep these balances with themselves. So scheduled bank, they have to keep it with RBI, CRR. But in this non-scheduled bank, they have to keep, but not with RBI, they have to keep it with themselves. They are not entitled to borrow from RBI for normal banking purposes, though they may approach the RBI for accommodation under normal circumstances. So for day-to-day business, they can't ask RBI for money, but in case of abnormal situations, they can ask, and it should satisfy to the RBI officials. Commercial banks can be classified as Indian and foreign banks. Indian banks are those banks which is incorporated in India, Companies Act 2013, and whose head offices are in India. Foreign banks are those banks which are incorporated outside India and whose head offices are outside India. HSBC, Hong Kong Shanghai Bank, DBS, Developmental Bank of Singapore, etc. Both types of bank will have to maintain CR with the RBI at a rate stipulated by it. Besides, RBI can also supervise overworking of the foreign banks operating in India. Commercial banks may also be classified as private and public. Private sector banks are those banks which the 51% of shares are held by private sectors, and if the 51% is held by Government of India, then it is public sector bank. Next we will see the functions of commercial bank. So as a commerce graduate, you have to know what are the functions of a bank. First, they will accept the deposit. Whatever business you do, you should have money in the bank. That's the reason they will be accepting deposits. Then they will give loan. What to do with the deposit? They will give a loan. Then sometimes they will invest. Sometimes they will act as per the instruction of the account holder. This is also a function, etc. So we will see majorly what are the functions in the as per the commercial bank. First is that acceptance of deposit. As I told, first accepting deposit. So it will accept two types of deposit. One is the demand deposit, one is the time deposits. Demand deposit is that account holders can ask whenever they want. Example, savings account. Whenever they want, they can give a check, draw it from ATM, transfer, anything they can do. Bank does not have the authority. In case of time deposit, which is the RD and FD, there is a certain specific time period. FD, it can range from 6 months to 1 year, or maybe 5 years, 10 years. It depends on the time when they have did. So demand deposits can be in the form of current account or savings account. So one more major account is the current account. Current account is only maintained by business persons. So there they can withdraw anything they can do. Here they won't provide interest to the balance. In savings account we get interest, but in current account we won't get any interest on the balances. These deposits are withdrawable anytime by the depositors by check. Earlier, now we can do it by UPI, NEFT, RTGS, any other thing. Current deposits have no interest or nominal interest. So current account holders will not get any interest. Such accounts are maintained by commercial firms and businessmen. Interest rate of the savings account varies from a time period. Savings accounts are maintained for encouraging savings of the households, as I told. Fixed deposits are deposits which are withdrawal only after a specific period. It earns a higher rate of interest. So the rate on FD will be higher than the savings account, because you will not ask the bank for certain period of time. No, so bank can invest in other things, and the return which they get, they will give higher to the account holders. Recurring deposit for fixed sum every month for a fixed period of time. So this is the recurring deposit. So once the bank accept the deposit, it can't keep it idle, because it will be lost. Now it will give to the customer itself in the form of loan, OD, cash credit, discounting trade bills, term loans, housing loans, car loans, etc. It extends loans and advances out of the money deposited by the public to various business units and to consumers against the sum approved. Usually banks grant short-term and medium-term loans to meet the requirements of the working capital of industrial units and trading units. Banks discourage loan for consumption purpose. Loans may be secured or unsecured. Banks do not give loan in form of cash. They make customer open account, transfer loan account to the customer account. So bank will not give directly cash to you. I want 1 crore loan. They will not give me 1 crore cash. They will transfer it to my account. Then only you can withdraw from that account. They will not give directly cash to you. So what are the types of loan? First one is OD. OD is that on the basis of your financial statements, on the financial strength of the company, the bank will give certain limit to you. Example, 1 crore. In 1 month you can withdraw up to 1 crore, not more than that. If your how much ever you withdraw, bank will charge interest on only that part and not on the whole 1 CR. If you withdraw 50 lakhs in a month, bank will charge only 50 interest on the 50 lakhs, not on the 1 crore. If you repay anything in between, it will take the net effect. Next, cash credit. Banks grant credit in cash to current account holders against the hypothecation of goods. So if you give any hypothecation, it will give cash credit. Discounting trade bills. Bank facilitate trade and commerce by discounting bills of exchange. So they will be discounting the bills of exchange. So if I have purchased a goods. Okay, so I'm sorry, I sold a good to some company. That company is a big company and they'll give me after 15 days. Now what I'll do, they'll give me in 30 days. Now I want the amount immediate. I'll approach the bank. Boss, I have sold this much amount to this specific company and definitely they'll give me after 30 days. Now what you do, you take my bill, give me amount, cut your charges. After 30 days, you only collect from the customer. So bank will see whether this customer is okay. Whether the customer, whether the person who has purchased the goods, is he okay? Then he'll take the bill, give the amount to us, deduct his certain charges. And after 30 days, what amount the customer will give it to me, I'll tell him, don't give it to me, give it to bank itself. Then bank will collect the amount. So in between, bank is making certain amount of commission for discounting the bills. So this is the discounting of bills of exchange. Term loan. So it will provide the term loans to traders as well as agriculturists on basis of some collateral. Consumer credit. It will provide a limited amount to buy the durable goods. Example, you will buy electronics, computers, refrigerators, washing machines. Whatever loan you get, it is known as consumer credit or durable loans. Money at call or short-term advances. Banks grant loans very short period, not exceeding 7 days, to dealers and brokers in stock exchange against collateral securities. So they will be providing for certain short period also. Credit creation. Credit creation is another banking function of a commercial banks. It manufactures money, which means it will give loan in the open market. Use of check system. So check system is that you will sign a check, you will give it to some person. If he goes to bank, he will get the amount. So which is also a good introduction in the banking system. Now the usage of check has come down because everyone will be using NEFT, RTGS, UPI if it is a smaller amount. Banks have introduced the check system for withdrawal of deposit. There are two types of check, bearer check and the cross check. Bearer check is encashable immediately at the bank by its processor. A cross check is not encashable immediately. Cross check is that this is the check, they will cross it here. If they cross, you will not get cash. The amount will be transferred from his account to your account. If it is a bearer check, it will be simply check, I will sign it here. If you go to the bank, bank will give you the amount. But in case of cross check, you won't get it. It will be transferred to your account only. So this is more safer because if someone finds this check, you can go to bank and take the amount. But this will not happen because it should be transferred to your account only. See, these services above which we saw is the banking services, deposits, loans, etc. Now we will see some of the non-banking services. So it will be doing some other services also. First one is the agency services. As I told, if you give a standing instruction to our bank, they will do the bill payments on our behalf. Example, payment of subscription, Netflix, Amazon Prime, etc. They will pay the rent, insurance premium. It collects bills, checks, demand drafts on behalf of their customers, act as a trustee, it acts as an attorney, acts as a correspondent. General utility service, it provides travelers checks, ATM facilities, it maintains the foreign exchange department, provides public provident fund deposits, pension funds, etc. So they will keep the depository services. So they will be providing the locker facilities, etc. So by this we have completed the commercial banks. Now we be going to the NBFCs. A non-banking financial company has been defined as wide class B of section 45(1) of chapter 3B of Reserve Bank of India Act 1934 as a financial institution which is a company. So first condition, it should be a company. Second, A non-banking institution. It should be a non-banking institution, which is a company and which has its principal business in receiving deposit in any scheme. Any scheme or arrangement or in any manner, lending in any manner. Such other non-banking financial institutions or class of such institutions as the bank may, with the previous approval of the central government and by notification in the official gazette. So we will see the definition. Non-banking financial company means only the non-banking institution which is a loan company or an investment company or a hire purchase financial company. So non-banking financial companies can be different types. It can be only loan giving, it can be only investment, it can be only a hire purchase or equipment leasing, etc. Is a company, non-banking financial company, is a company registered under the Companies Act 1956. No, now it is 2013. Engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by the central government or local authority, or other marketable securities like leasing, hire purchase, insurance. It can be anything. So here we have the different types of NBFCs. See, first one is the asset finance company. What is that? An asset finance company is a financial institution carrying on as its principal business of financing the physical assets, supporting productive economic activities such as automobiles, tractors. So it will be providing loans for the purchase of automobiles, tractors, lathe machines, generators, etc. Principal business is defined as financing real or physical assets, supporting the economic activity, and income arising therefrom is not less than 60% of the total assets. So it will be mainly lending for assets, for buying assets. Investment means it is carrying on the business of acquisition of securities. Simple. Loan company is only providing finance, whether making loans or advances or otherwise for any activity other than its own, but does not include a finance company. So it will be only engaged in providing loans. Next, infrastructure. Infrastructure means it will be giving only for infrastructure facilities, which deploys at least 75% of its total assets in infrastructure loans. If it is having 100 CR, 75 CR, it should give for as infrastructure loans only. As a minimum net owned funds of 300 CR, it should have a minimum amount of 300 CR and minimum credit rating of A or equivalent or CRAR of 15%. Systematically important core investment company. So what is this? Is an NBFC carrying on the business of acquisition of shares. Since it is an investment company, it is acquiring shares and securities which satisfies the following conditions. It holds not less than 90% of its total assets in the form of investment in equity shares. So 90% of total assets should be in the form of securities investment. Okay, 90% of its total assets should be invested in the form of equity shares, etc. Not exceeding 10 years from the date of issue in a group companies which constitute 60% of the total. Okay, it does not trade in investments shares except through block sale for the purpose of dilution or disinvestment. It accepts public fund and other things. So it is mainly concerned with the investment. Next, infrastructure debt fund. This is an NBFC which facilitates flow of long-term debt in infrastructure projects. Raise resources through issue of rupee or dollar denominated bond with minimum 5-year maturity. How will they get money? They'll give the bond to the general public. It may be rupee or dollar. Then it will invest in the infrastructure projects. Only infrastructure finance company can sponsor IDF NBFCs, which means infrastructure debt fund. Next, what is this? NBFC microfinance institutions. So this is a type of NBFC, microfinance institutions. But to be a microfinance institution, it has to satisfy so many conditions. First, loan disbursed by NBFC, microfinance institution, to a borrower with a rural household annual income not exceeding 1 lakh or urban or semi-urban exceeding 1 lakh 60. So it should give loan to only people who having an income less than 1 lakh in case of rural and 1 lakh 60 in case of urban and semi-urban. I'm sorry. Loan does not exceed 50,000 in the first cycle and 1 lakh in the subsequent cycle. So in rural it can give 50,000 in first time and up to 50,000 in first time and not more than 1 lakh in subsequent cycles. So the maximum amount which you can avail from here is that 1 lakh and 50,000 in case of first time. Total indebtedness of the borrower does not exceed 1 lakh. As I told, total indebtedness cannot be more than 1 lakh from each customer or each account holder. Tenure of the loan should not be less than 24 months, which means it should be more than 2 years for the loan amount in excess of 15,000 with prepayment without penalty. So here, if you take loan, it should be not less than 24 months. It should be more than 24 months, but the amount should be more than 15,000. Nowadays, people won't take these loans because the amounts are very less. 15,000 you can get anywhere. But the condition is that if the amount is more than 15,000, the minimum period is 24 months. But there is no pre-closure penalty. That also they have told. See, prepayment penalty is 0. Loan to be extended without collateral. So you will get loan even without any collateral. Aggregate amount of loans given for income generation is not less than 50% of the total loans. So they are telling that aggregate amount of loans given for income generation is not less than 50%. So at least 50% of the loans you should get some income out of it. Loan is repayable on weekly, fortnightly and monthly installments. So these are some of the NBFCs. So what are the objectives of NBFC? First, to ensure healthy growth of financial companies. First is the healthy growth. Ensure that these companies function as a part of financial system within the policy framework. Okay, in such a manner that their existence and functionality do not lead to systematic aberrations. Then the quality of surveillance and supervision exercised by the bank over the NBFCs is sustained by keeping pace with the developments that take place in this sector of the financial system. It has been felt necessary to explain the rationale underlying the regulatory changes and provide clarification on certain operational matters to benefit the NBFCs. So that is not important. So this is the main important thing here. Differences between banks and NBFCs. NBFC cannot accept demand deposit, which is the main difference. NBFC do not form part of the payment and settlement system because they can't issue checks. Deposit insurance facility is not available. So DAC-GC insurance, which is available to the banking business, is not available to this NBFCs. So better keep deposits in the nationalized banks or the private banks where DAC-GC is available, because if suppose we can't take call on banking business, it may go down any time, but if you are having an insurance on that, well and good, you will get your amount back. So that's the reason, if you are having, I think DAC-GC limit is 5 lakhs now. So try to plan your investments or the deposits, keep 5 lakh in every banks, not the whole amount in one bank, because if suppose, it may not happen, but if suppose if the bank goes down, your deposit is gone. If you are keeping in different banks, you will get the DAC-GC insurance on all the amount. So this was one advice. So registration requirements of NBFC. If you are not registered as an NBFC, you can't even start the business. In terms of 45IA of the RBI Act, no NBFC can commence or carry on the business of the NBFC financial institution without obtaining a certificate of registration. You can't even start. And without having a net owned fund of 25 lakh, minimum you should have 25 lakh fund. However, in terms of power given to the bank to avoid dual regulation, certain categories of NBFC which are regulated by other regulators are exempted from the requirement of registration of RBI. Normally, every NBFC should be registered under RBI. There are certain NBFCs which is regulated by other financial institutions or other agencies. So those NBFCs are not required to register under RBI. Example, venture capital fund, merchant banking companies, stock broking are registered under SEBI. Insurance are registered under IRDA. Nidhi companies are registered under Companies Act. So these NBFCs are not required to register under RBI. They will be registered under respective acts, IRDA Act, SEBI Act, etc. Housing financial companies in case of Nidhi chit companies. So there are certain NBFCs which are exempted from registration because they will be registered under some other act. That's the reason they are not liable for registration under RBI here. Which are those? Housing financial companies, merchant banking companies, stock exchanges, in the business of stock broking. These are registered under SEBI. Venture capital funds, Nidhi companies, insurance companies. These are some of the companies which are exempted from registration under RBI. They have to take registration, but not under RBI. Different agencies, SEBI, IRDA, Companies Act in case of a Nidhi company, etc. Housing companies are regulated by National Housing Bank. Merchant bankers, venture capital funds, stock exchanges, stock brokers, sub brokers are registered under SEBI. Okay, insurance companies are regulated by IIRDA. Similarly, chit funds are regulated by respective state governments, and Nidhi companies are regulated by the Ministry of Corporate Affairs under the Companies Act 2013. Now, it may be mentioned that the mortgage guarantee companies have been notified as NBFC under the 45 IF3 subclass 3, class F subclass 3. So this can be asked in choose the correct answer or fill in the blanks. Please be careful. Next, residuary non-banking company. Residuary non-banking company is a class of NBFC which is a company and has its principal business of receiving deposits under a scheme or arrangement or in any other manner not being investment, asset financing, loan company. These companies are required to maintain investments as per the directions of RBI. In addition to liquid assets, the functioning of these companies is different from those of NBFCs in terms of method of mobilization of deposits and requirement of deployment of depositors fund as per the directions. So this is the residuary thing. Please mark it as important, may be asked in exam. Next we will see the insurance companies. So insurance companies. So in India, the most famous insurance company is LIC, Life Insurance Corporation. So insurance industry in India is divided into two types. One is the public sector, one is the private sector. So everywhere you will get only two types of insurance. One is the life insurance, one is the general insurance. So life insurance, it is very much concerned to our life. So if we die in future due to natural calamities or unexpected circumstances, so our family will get the amount. General insurance, which we take it on our vehicles, on companies, trade, shops, etc. So these are some of the general insurance. So general insurance corporation and its subsidiaries are the example in case of public sector. In India we have LIC or postal life insurances, and in private sector also bank will provide the insurances, and other insurance companies are also there. We have the Digit now, we have the Acco insurance, which will provide insurance for automobiles, etc. So the insurance companies are the So insurance companies provide insurance for long period of for the longer period, which is 30 years, 40 years, or maybe after retirement. If you take at the age of 20, you may get after 60 years. So these are some of the time periods. So the insurance companies are active in the following fields, among other, so life, health and general. So majorly insurance will be available on the three fields: life insurance, health insurance and general insurance. If you are taking insurance, you will be covered or sorted out. If there is any unexpected circumstances also, you are sorted out. And they have begun to operate in pension schemes and mutual funds also. Insurance business consists of spreading risk over time and sharing them between persons and organizations. The major part of insurance business is life insurance, the operations of which depends on the loss of mortality. The distinction between life insurance and general insurance business is with that regard of the former, the claim is fixed and certain, but in case of latter, the claim is uncertain. So in life insurance, the claim is fixed, you will definitely take the claim, but in case of general insurance, there are chances of taking also, not taking also. Now if you take an example of motor vehicle insurance, you may meet with an accident or may not meet with an accident. If you meet with an accident, you will get the claim. If suppose you have taken an insurance for 1 year and you did not face any accident issues or any natural calamities, then the insurance premium is gone. It is an income for the insurance company. You would have not claimed anything. So that is the reason, main difference. The amount of claim is variable and is ascertainable only after some time after the event. Pension business is a specialized form of life assurance. So insurance, if you take, they can provide pension also in some cases. There are certain insurance sector reforms. What are the reforms? We will see that. Insurance sector in India has gone through a process of reform following these recommendations. The IRDA bill was passed by the Indian Parliament in December 1989. The IRDA became the statutory body in April 2000 and has been framing regulations and registering the private sector insurance companies. The insurance sector was opened up for private sector in 2000. So earlier it was only given by the government public sector. Now after 2000, once the IRDA is established, now they are giving license for private insurance companies also. Consequently, some Indian and foreign private companies have entered the insurance business now. There are 31 general insurance and 24 life insurance companies operating in the private sector in India in early 2022. See, 31 general insurance and 24 life insurance companies are there. They might be making heavy amount in terms of premium, because in general insurance the claim is very less or minimal. I can tell, not less, you can tell minimal or not as life insurance, because that's the reason the income of the life insurance companies will be always more. So what is the statutory function of IRDA? So issue to the applicant a certificate of registration. First they'll issue the registration, then renew, modify, withdraw, suspend, cancel, everything related to certificate of registration. Then protecting the interest of the policy holders in matters concerning the policy, nomination by policy holders, insurable interest, settlement of insurance claims, surrender value, etc. Then specifying requisite qualification, code of conduct for the agents, etc. They will be registering the insurance agent. Specifying the code of conduct for surveyors and loss assessors. So they will be specifying the code of conduct. Promoting efficiency in the conduct of insurance business, efficiency and effectiveness. So levying fees, promoting the professional organization connected with the insurance and reinsurance, calling for information for inspection, etc. So these are some of the functions. Maintaining the margin of solvency, tariff advisory committees, and these are some of the statutory functions of IRDA with relation to insurance business. So these are some of the list of life insurance companies in India. So as I told, LIC will be leading every time. Then we have HDFC, Max, ICICI, Tata, Aditya Birla, Kotak, and these are some of the life insurance companies in India. As I told, 24 life insurance, and I think in general insurance we have 31. Yeah, 31 we have. So these, as I told, see, ACO, they will be providing for in automobile. everywhere they are there. Insurance companies, see Go Digit, as I told, HDFC, Ergo, ICICI, Lombard, Kotak Mahindra, Liberty. So if you take a vehicle and you see there will be an insurance company everywhere, that will be either from these 31. In case of general insurance, if it is a life insurance, it will be one among these 24. Okay, so these are the examples. If they ask in exam, you can quote it. National Insurance Company is the most popular. So Royal Sundaram, SBI. See, every bank has its insurance almost. Next, so this comes to the end of insurance companies. So insurance companies, majorly we saw types of insurance and the statutory function. That's it. And the examples. So next we will see the pension funds. So pension funds are now grown rapidly to become the primary vehicle for retirement benefit and retirement savings. So pension funds are very much increasing because after 60 years nowadays people won't have any income, or they'll take a retirement life and enjoy with the funds which is coming from the pension funds. So now LIC is also giving. Now we have Atal Pension Yojana, which is the national pension scheme. Now in NPS we will be depositing till the age of 60, and after 60 we will take a part amount as lump sum and take the remaining in the form of annuity or on the monthly basis. Retirement income in many countries. A pension plan is an arrangement to provide income to the participants in the plan when they retire. In India it is 60 to 62 years. Pension plan are generally sponsored by private employers, government as an employer, and labor unions. They may be funded pension plans or unfunded pension plans. If the benefits promised by the pension plans are secured by assets specifically dedicated to that purpose, it is called FPP, which is the funded pension plan if it is having some assets for this purpose only. If the fulfillment of the promised benefits by the sponsor depends on general credit and not by a specific contribution to be made year after year, it is called an unfunded pension plan. There may also be individual retirement pension plans also. Classification of pension plans. A financial intermediary or an organization or an institution or a trust that manages the assets and pays the benefits to the old and retires is known as pension fund. So the financial intermediary or an organization or an institution or a trust, it can be anything that manages the assets and pays the benefits to the old and retirees is known as pension fund. Every big company will have their own pension fund organization, and that company cannot take a single penny from that retirement organization. The fund should be utilized only for one purpose, paying the pensions. It cannot be diverted to any other business functions. Some pension plans are said to be insured. In such cases, the sponsor pays premium to the life insurance company in exchange for a group annuity that would pay retirements to the participants. So there are these are some of the classification: defined benefits, defined contribution pension plan, or pay as you go pension plan. So these are the types of pension plans. So the first one, defined benefits pension plan, is a predefined based on a final salary and the period of service. Most of the pension plans offered by the public sector enterprises and the governments as employer in India are DBPP, I'm sorry, it's a bit confused, DPVV, DBPP, see, tongue twister, DBPP policy, most of the funds. Then DCPP, defined contribution pension plan. It is popular in US, do not guarantee the amount of final benefit which the employees would get after they retire. In DCPP, the employee and the employer make a predetermined contribution each year, like the PF which we make month on month. These funds are invested over a period of time till the retirement of the employee. Whatever the value of this investment at the time of retirement, the employee will get a certain amount which he would use to purchase an annuity. From the point of view of the employer, DCPP is known as money purchase pension plan. Pay as you go pension plan. In most European countries, including France and Germany, pensions are paid through PAY pay as you go pension plan, under which the current employees pay a percentage of their income to the old, and this along with the contribution of the state goes to the pension, and that sustains the older generation. In US there has been a trend towards the decline in DBPP and an increase in DCPP pension plan. So this is the thing. So it is bit confusing, but understand the important points. DBPP is mostly used, and it is given by the government or the public sector enterprises. And here understand the difference, that's it. Next, management of pension funds. Some sponsors of pension plans manage their pension funds themselves, but most of these sponsors appoint a trustee to do on their behalf. So they'll appoint a trustee to make best utilization of the pension funds. This trust is usually a trust department of a commercial bank or an insurance company or a mutual fund. The trustee manager invests contribution provided by the sponsor and pays benefit to the retirement person. In case of DBPPs, the assets of the pension fund remain the property of the sponsor, who sets a general investment policy in respect of portfolio composition. So he'll tell that this should be my portfolio composition, this should be my target return, and this should be my quality of securities. In terms of risk should be less, no? That is the thing. The fund manager takes day-to-day decisions by buying and selling the specific assets. Some large sponsors may divide the management of their PNFs among several trustee managers. There are certain advantages of managing PNFs by outside trustees, because transaction costs are lower, the trustee will have the great subject matter expertise, and he possesses all the necessary personal equipment and expertise in the regulatory requirements, and he enhances the credibility of the pension plan. Next we have, what is the pension system in India? In India, pension system coverage is very small at present. The pension market in India is highly unorganized, which covers hardly 3% of the Indian population. See, it is covering only 3%, which is very less when compared to the population. The Employee Provident Fund, the PF, the Employee Pension Scheme and the PPF are only schemes. See, in India we have only three: EPF, EPS and the PPF, Public Provident Fund. Public Provident Fund anyone can open. Go to the nearest bank, nationalized bank, ask for a PPF account, you can invest in it. The return on the PPF is the highest. It is even more than FD, which cover the pension market in India. The regular salaried employees in the organized sector have been relatively better off in the public policy, provided vehicles for compulsory savings and old age provisions. It is estimated that around 23% of the employed in the government sector were the beneficiaries of the government defined benefit pension scheme, and 49% of the employed in private sector were covered under mandatory employee provident fund. So every company should take a provident fund registration compulsorily, and it should deduct from the employee. If you see, there will be certain amount deducted from your salary in the form of pension. So if you take the overall CTC, the provident fund is the main thing. So there is a deduction of around 1,800 maximum, and over and above that, if you want, you can tell to your employee that deduct this much amount. In the last 7 years, from 2000 to 2007, I have seen a marked shift in the pension policy in India through introduction of new pension scheme. Oasis committee has recommended two major pension reforms for the government employees and the unorganized sector. The efforts culminated in setting up the Pension Fund Regulatory and Developmental Authority in 2003. So, on the basis of the recommendation of the committee, there was a authority established, which is the Pension Fund Regulatory and the Development Authority in the October 2003. The Pension Fund Regulatory and Development Authority was established by the Government of India on August 23, 2003 to promote old age income security by establishing and developing a pension funds to protect the interest of the subscribers and schemes of pension funds or matters connected therewith to or incidental thereto. So first we will see some of the pension plans. Government employees pension scheme. So this is only given to government employees, as the name suggests. The government employees pension scheme, which has been made mandatory from 1995, it is a subset of the employee provident fund. It provides superannuation fund, retirement pension, permanent total disability pension, widow pension, widow or widower pension, orphan pension, etc. It is essentially a defined contribution and defined benefit pay as you can scheme, which is diverting 8.33% of the employer's existing share of payoff. So there will be total deduction of 12%. In that, 8.33% of employer portion will go to pension. The central government contributes amount equivalent to 1.16% of the worker's salary. A scheme provides a minimum pension of 500 per month and a maximum pension of 60% of the salary. So they will get 60% of the salary as pension. All assets and liabilities of the erstwhile family pension fund scheme have been transferred to GEPS, Government Employee Pension Scheme. After the introduction of the scheme, employees who have enrolled in the LIC pension will also obtain the pension benefits from GEPS, which is also known as Employees Pension Scheme. Okay, the important thing is mainly invested in government security. See, the pension funds cannot be invested everywhere. They should be in the less risky. So less risky is government security and government special deposit scheme, etc. Central Provident Fund Commissioner is eligible for government contribution of 1.16. That is the important thing here. Next, bank employees. So bank employees will have their own pension scheme for the benefit of the employees of public sector banks and government owned insurance companies respectively. They are financed by the entire employer portion of PF contribution, which is 10% of the basic salary. So they will be paying as per the norms. This is the main thing. Privately administered superannuation fund. Companies, big MNCs will have their own superannuation fund or the pension fund of the companies. So far, in the private sector has been kept out of in respect of setting up and running pension funds. They have been run by government and semi-government organization. If an employer sets up a privately administered superannuation fund, it is stipulated that he can accumulate funds in the form of an irrevocable trust fund during the employment period of the employee concerned, and when the pension becomes payable, suitable annuities have to be purchased from the LIC. So they can't do anything, they have to purchase it from the LIC. Alternatively, employee can have superannuation scheme with LIC and pay suitable contribution for the employees in service. So instead of doing this, they can directly purchase a LIC policy. Varishta Pension Bima Yojana, New Jeevan Akshay, New Jeevan Dhara, New Jeevan Suraksha. These are some of the pension plans by LIC. So now we have left with the alternate investment fund, which is the angel fund, venture capital fund, and the private equity fund and hedge fund. Next, we have the alternate investment fund. So we'll see what is the meaning of alternate investment fund, which is the angel fund, venture capital, etc. So alternate investment fund means any fund established or incorporated in India, which is a privately pooled investment vehicle which collects funds from sophisticated investors. So it will be collecting funds from the sophisticated investors. It may be Indian or foreign, for investing in accordance with the defined investment policy. So it will be investing in accordance with the defined investment policy for the benefit of the investors. AIF does not include funds covered under SEBI regulations related to mutual fund, collective investment schemes, or other regulations of SEBI to regulate fund management activities. Further, certain exemptions from registration are also provided under IAF regulations mainly to family trusts set up for the benefit of relatives as defined in the Companies Act. Employee welfare trust, gratuity trust, etc. are exempted or which are not included in AIF. So we'll see what are the category. So category 1. In category 1, AIF which invest in startups and early stage ventures and social ventures or SME, small micro enterprises, or infrastructure or other sectors or areas which the government or regulators consider as socially or economically desirable and shall include venture capital funds, SME funds, social venture funds, infrastructure funds, or such other alternative investment funds may be specified. Next, we have the category 2. Category 2 is that which does not fall into category 1 and 3 and which do not undertake leverage or borrowing other than to meet the day-to-day operational requirements. So alternate category 2 is only for day-to-day operational requirements, but in category 3, which employ diverse and complex trading strategies and may employ leverage including through investment on listed or unlisted derivatives. So they will be investing in derivatives. So we will see what is angel fund. Angel fund is a subcategory of venture capital fund under category 1 AIF that raises funds from angel investors. So would have seen in the Shark Tank, angel investors, word you would have heard in the Shark Tank, and invest in accordance with the provisions of AIF regulations. In case of angel fund, it should not only raise by way of issue of units to angel investors. So angel investors will commit to put money in the companies. Angel investor means any person who proposes to invest in an angel fund and satisfy one of the following conditions. So what are the conditions? An individual investor who has a net tangible asset at least 2 CR, excluding value of his principal residence. So he should be having net worth of 2 CR excluding his house, and who has early stage investment experience. So he has some investment experience and a serial entrepreneur, or is a senior management professional for at least 10 years. So you should have a experience of 10 years as a management professional, the 2 senior. For this purpose, early stage investment experience shall mean prior experience in investing in startup or emerging or early stage ventures or serial entrepreneur, and shall mean a person who has promoted or co-promoted more than one startup venture. You should have promoted one startup, and it can be a body corporate which at least 10 CR net worth. If it is a body corporate, 10 CR. If it is an individual, 2 CR excluding his residence. An alternate investment fund registered under these regulations or a venture capital fund registered under the SEBI Venture Capital Fund Regulation 1986. Next, investment in angel funds. Section 19D of the SEBI regulations state angel fund shall only raise funds by issue of units. So it can give units and take the money. No other way it can take or accept the money. Angel shall have a corpus of at least 10 CR. It should have a corpus which means the reserves and surplus of 10 CR. Angel fund shall accept up to a maximum period of 3 years an investment of not less than 25 lakh from an angel investor. So 25 lakhs is the minimum amount and 3 years is the minimum lock-in period. So maximum lock-in period. Okay, minimum a person can invest 25 lakhs, not less than 25 lakhs. Angel fund shall raise funds through private placement by issue of information memorandum or a placement memorandum by whatever name called, because it can take only by sale of units. Investment by angel funds. As per 19F of the SEBI regulation, angel funds shall invest only in venture capital undertakings which have been incorporated during preceding 3 years. So if you are planning to invest today, it should be established within 3 years from today, preceding 3 years. So now the date, today if it is 2024, it should have been established after 2021, not before that. Then you cannot invest in that. Have a turnover of not less than 25 CR. So it should have a turnover of 25 CR. Are not promoted or sponsored by any related to any industrial group whose group turnover exceeds 300 CR. It should not be related to a group whose turnover is 300 CR. For the purpose of this clause, industrial group shall include a group of body corporates with the same promoter or promoter group. A parent company and its subsidiaries, a group or body corporates in which the same group of persons exercise control, and a group of body corporates comprised of associates, subsidiaries and holding companies. Next we will see the venture capital fund. Venture capital funding is different from traditional sources of financing. Venture capitalists, normally known as VCs, finance innovation and ideas which have the potential for high growth but with inherent uncertainties. So the best example for this is Shark Tank. So those 5 people are known as VCs. This makes it a high risk, high return investment. The risk is also high, the return is also high, but there are chances of going down also. Apart from finance, venture capitalists provide networking, management and marketing support. So they'll provide all-round support for a company. In a broadest sense, therefore, venture capital connects risk, finance as well as managerial support. They'll give fund also, they'll give support also. In the global venture capital industry, investors and investee firms work together closely in an enabling environment that allows entrepreneurs to focus on value, creating ideas, and venture capitalists to drive industry through ownership of levers of control in return for a provision of capital, skills, information and complementary resources. This is a blend of risk financing and hand holding of entrepreneurs by venture capitalists to create an environment particularly suitable for knowledge and technology based enterprises. So they'll do hand holding also, they'll take a risk also. That is the reason they expect more return. VCs. As per 2(1)(z) of the Securities SEBI Alternative Investment Fund Regulations 2012, venture capital fund means AIF, which invest primarily in unlisted securities, private limited companies or startups, emerging or early stage venture capital undertakings mainly involved in new products, new services, technology or intellectual property right based activities. So minimum investment is 5 lakh. So venture capital fund may raise monies from an investor, whether Indian, foreign or non-resident Indian, by issue of units. So it can take by anything. No venture capital fund set up as a company or any scheme of a venture capital fund shall accept any investment from an investor which is not less than 5 lakhs. So minimum to minimum they have to take 5 lakhs in case of a VC. In case of AIF it should be 25 lakhs. Private equity fund. As per section 2(1)(r) of the 2 subsection 1 clause R of the Securities and Exchange Board of India Alternative Investment Fund Regulation 2012, private equity fund means AIF which invests primarily in equity or equity linked instruments or partnership interest of investee companies according to the stated objective, which means they'll mainly invest in equity instruments. Okay, next, hedge funds. Hedge funds are private investment vehicles not open to general investment public. Hedge funds face less regulation than publicly traded mutual funds. Mutual funds are highly regulated, whereas hedge fund is not so much regulated, allowing them to hold substantial short positions to preserve capital during market downturns. Typically, hedge fund managers generate profit from both long as well as short positions. Private nature of the hedge fund often suits both needs of investors and managers. So features of hedge fund: reduce risk, enhance returns and minimize the correlation with equity and bond market. Flexible in investment options. Variety in terms of investment returns, volatility and risk. Managed by the experienced investment professional who generally disciplined and diligent. Pension funds, endowments, insurance companies, private banks and high HNIs and families invest in hedge funds to minimize overall portfolio volatility and enhance returns. Hedge funds benefit by heavily weighted hedge fund managers' remuneration towards performance incentives. So there are some of the strategies. What is that? Selling short. Selling short without owning them to buy them back in the future date at a lower price in expectation that the price will drop. Now selling short is one feature. Now you will sell it off, but as per regulation that you have to purchase within certain days. Now I sold it off for 1000 rupees. Maybe as per the information or as per the market condition the price came down to 800. Now I will purchase it at 800. Usually first buy then sell. The business function is that first you will buy then you will sell. But in case of short selling, first you will sell then you will buy. That is the difference in short selling. So now you sold for 1000. buy it at a future date, or maybe 2 weeks, buy it at 800. Now you are at a profit of 200 rupees. That is short selling. Using arbitrage, seeking to exploit pricing inefficiencies between related securities. There will be sometimes arbitrage effect also. Trading options and derivatives. So contracts whose values are based on performance of underlying financial asset or index or other investment. So derivatives will derive value from the underlying investment. It may be commodity, it may be shares, it may be other securities also. Investing in anticipation of specific event, merger transaction. So you will take a call now only based on some under anticipation of certain specific events. Investing in deeply discounted securities of companies about to enter into exit financial distress or bankruptcy, often below liquidation value. So you can invest in deep discounted securities also. What are the benefits? First is that we'll get higher returns, investment style, long-term solution and diversification, because it will be investing in everything. So SEBI regulations including AIF circular. So SEBI has given what are the certain regulations which should be followed by all the AIFs. So the preamble of Securities and Exchange Board of India describes the basic functions of the board, which is that to protect the interest of the investors in securities and to promote development of and to regulate the security markets or matters connected therewith or incidental thereto. So this is the agenda or the preamble of the securities, to protect the investors in securities and to promote the development and regulate the security market and the matters connected therewith. Okay. So the role of SEBI or steps taken by SEBI for development of capital market. So what is the role of SEBI? First, they will be inspecting the stock exchanges. First is the inspection, because there are chances of insider trading, etc. Then inspection of mutual funds. So they'll inspect the stock exchanges also, they'll inspect the mutual funds also. In this respect, it has already been undertaken inspection of some mutual funds. Various deficiencies of the individual mutual funds have been pointed out in the inspection reports and corrective steps have been undertaken. Then measures to reform the primary market in order to make stronger the standards and disclosure. Then registration of intermediaries, that is also role of SEBI. In order to encourage companies to exercise greater care of timely action in matters relating to public issue of capital, SEBI has advised stock exchanges to collect from companies making public issue a deposit of 1% of the issue amount, which could be forfeited in case of non-compliance. So the stock exchanges are expected to take 1% of the issue size, which can be forfeited if there is any non-compliance. So then they will be having governing boards of the stock exchanges and change the composition as required when there is a default and such other function. Then this is also main thing, insider trading. If there is any insider trading, impose penalty or restrict them from continuing the transactions in the shares. And separate guidelines for developmental financial institutions, etc. These are some of the important. So direction for contract notes, you would have heard in, if you are making trading in shares, you will know this term, contract notes. Preferential body issues of orderly development, banker to the issue. So these are some of the important roles. So this you can go through. So and now we have all these SEBI regulations. So these are the SEBI regulations as per the requirement. So each and every time if there is a new problem, come out with a new regulation. So this is the list. See, vault managers, portfolio investors, these are all the regulations given by the SEBI. So yes, by this we have completed the financial institution, which is the first part. In the next section we will be doing the capital market, and following that we will be doing the money market. So thank you guys, thank you for your time. Thank you.